Okay, so it's More Money Monday. Today is September 9th, and welcome to More Money Monday. Bye, Rosie. She's stepping out the door. So we're gonna give the floor to Brad Turpin with Encompass Lending because we have some rate changes coming up. I think the Fed's gonna cut rates again. We just don't know how much. That seems to be the news cycle. So I'm gonna give Brad that information, let him share that with you, and then also the new programs that are coming up that are updated. So with that, go ahead, Brad.
All right. Thank you, Krista. So yeah, the Feds will be meeting twice before the end of the year. And there is speculation that they are going to be doing, half a point reduction on this end of this month, and then probably a quarter point, although they could do another half a point. So we have the potential between a half a point total and 1 point total of reduction to interest rates before the year's over. Now, one big misconception is that when the Feds lower rates, that mortgage rates immediately fall. The reason that that's a misconception and it's not true is that when the Feds affect their interest rates up or down, they are impacting consumer debt. So your student loans, car loans, credit cards, anything of consumer ability. Mortgages, those are traded daily. Those are done through securities and bonds. And as a result of that, because they're traded daily, when things get chaotic, like when the stock market drops 500 points, we see the same chaos in mortgage bonds. Sometimes we could have 3 reprices in a day, good and bad. But when we see the Feds cutting rates, it's indirectly good news for mortgage rates. And the reason it's indirect is because when Feds are cutting rates, that means inflation is now under control, or there's some other issue that needs subsidy. And so what will happen more than likely on this go around, because historically, mortgage rates typically will start to slide upward a little bit through the end of the year. And that's just because day trading starts to diminish. The day traders are made their money. Now they're going to spend time with their family through the holidays. And so we usually see natural progression up. As the Feds cut rates, then the first of the year will start, and then we'll get back into the groove. And then that's when we should start seeing mortgage rates come down. So by February, maybe even March, those will start having impact, and we should see rates fall into the fives. And when that happens, and as you know, there's a lot of people that are just sitting, waiting because they have that 3% mortgage, whether it's them, looking to move up or down, whether it's to buy that next property, help their kids out, whatever the case may be, they don't want to touch that. So now that expectations have been reset, once those rates come down into the fives, we're going to see a lot more activity. So you guys need to be ready and be able to have that communication with your buyers if you have those that are sitting on the fence waiting. Now, with that, we have one new program that's really remarkable, in my opinion, and it's essentially called the Trio, and through a link loan. And that the reason it's a link loan, I wonder if I can share my screen. All right, everybody see that?
Yeah.
Yes? No?
Yeah.
Okay. So this is an FHA-based loan, and where it's really powerful is that it's a lease to own. And so rather than trying to locate a seller that will lease the property back, get them locked in, this essentially, reason it's a Trio program is there's 3 people. You got the seller, the buyer, and then you have your holding company. And so essentially the holding company will purchase the home on behalf of the buyer. Their mortgage payment will become their lease payment for about 3 years. And during that lease period, a portion of that payment, like an equity share, and that's really kind of how this is devised through HUD, is kind of taking all the best parts of the equity shares out there and rolling it into this program. And so it is HUD insured or government insured, HUD backed. And basically a portion of their payment will then go towards their down payment. And once that 3.5% down payment is collected, then essentially it's a refinance transaction that then transfers that title from the holding company to the borrower. So it's really great for those buyers that can't get ahead. We know things are overly priced and expensive. Inflation is through the roof, although it seems to be coming down, but those numbers are arbitrary. It's still, cost of living is still high. And so if they're just not disciplined enough and not able to get ahead, they're going to pay rent anyways. This is a great tool for them to be able to step foot in the door and at least maximize that ability on home ownership. And the downside to it, if there is any, is that during that 3-year period, they don't have the benefit of the mortgage interest deduction because they don't physically own the property. But again, it's the cost of doing business. It's not, the right shoe for every foot. It is just another tool in the belt. And maybe down payment assistance is a great program. But this one definitely has its pros and cons and benefits. There's definitely some affordable ways to get people into the home. And it's just another tool because ultimately, rather than putting them into a lease with a seller, where you then get minimal commission for hooking up that lease agreement, this actually closes on the transaction on the property. So it's your normal commission accordingly. And then the lease is held with the holding company directly. So it's a powerful tool. And ultimately, we just need to have more tools in the belt to be able to help our buyers and discuss with our buyers to get them into home ownership. And the more flexible we are, the more opportunities we're going to have. So, I'll send out, this flyer I can send out to, actually I already sent it to Krista, and then Krista can share, this is very vague, obviously. They're working on getting some more material. And what I can do is, let me see, I'll show you kind of a comparison here. So this is more on the guidelines. And, you can see that there's two different, you got the link program and then the convertible link. Essentially, they're doing the same thing, but one is intended for a little bit lower FICO score, so it's going to have higher pricing by comparison, because they allow for that lower FICO score versus 600 on the basic model. And then your debt to income ratios obviously run kind of in line with FHA. The lease payments usually run about 38% of their debt to income ratio, so that it's in tune with what a mortgage payment will be, and then they don't get hit too heavily with payment shock. So I'll go ahead and show this to everybody. This might be a little too much in detail for most real estate agents, but at least you have some information on it, some talking points with your clients. But I would like to open it up for questions, because I'm sure there's a slew of questions on a program like this. Just because it is new. One of the other benefits before we open that up is, comparing this to any other equity share program, because there are a lot of them out there where people can go and be in the apartment complex and build their equity share. The problem with any of those is that, like Toll Brothers is a big one that'll do it. And then you have to buy a Toll Brothers home. And what if, they're in that apartment complex for 3 years, 4 years, 5 years, whatever that time is, and then there's no Toll Brothers developments active around them. So now the money is wasted, or they have to relocate to wherever that development is, and that might not be in the ideal spot for where they want their children to go to school and so forth. So that's the downside to a lot of the equity share, where this can be used on any property as long as it meets the FHA criteria. So obviously that's the kicker, is being FHA backed. If it's a condo, that's going to be your biggest concern, is whether that complex is FHA approved. So, but I can always help with getting you details on that accordingly. And then obviously county limits are also going to play a factor in there as well.
Okay, Brad, I have a question.
Yeah, please.
Okay, let's run a scenario. So
Yep.
let's say I have a son who's at school out of state. He's working full time and he's going to school. And we were thinking about waiting until he was done with school to get him into a property just because.
Yeah.
But let's say we wanted to go ahead and do it. I saw on there, and now, where is it on this thing? I'm scrolling. It says that there is a non-occupant
Yep.
co-borrower.
Right here.
Yeah. Non-occupant co-borrower allowed. So let's say I wanted to be a co-borrower. Normally we could do that anyway, right? We could go on title with our college student.
Yeah, so there's a couple pieces to it. So obviously being a college child, so essentially we call these kiddie condos, if you will. Right. And so, he doesn't have the income yet to be able to qualify on his own. And so that's where the non-occupant co-borrower comes in. You would then use your disposable income to, basically back your child. They get in the home. For all intent purposes, they are the primary owner and occupier of that property. And by you essentially, insuring that loan or, co-signing, if you will, your credit is qualified. Your income is qualified. Everything is qualified for the sake of you buying it. But really, he's buying it, and then you're just backing it. And that's really how then it's able to go through, because that payment's going to be backed by you accordingly. Right. And then because it's FHA, you don't have to claim that you're going to live in the home because he is the occupant. And so that's the beauty of it, because, otherwise most FHA loans have to have pure 100% owner occupancy.
Yeah. And you can still do seller contribution, right? So
absolutely, up to 6%. And that's the beauty of FHA program, because it is so high on the seller contributions, and commissions don't count towards that 6%.
Okay. So so using this program, then what's the benefit of doing the link program versus just trying to buy?
Well, if you were to do the exact same FHA, straight up versus a link program, then you would have to come in with the 3.5% down, right?
Okay.
So essentially, if we were looking at $300,000, you're looking at over 10 grand, right? And you've got to have that down payment at the close plus closing costs, unless we get seller concessions to take care of that. Where this would come in is that, and that's why I say it's not for everybody, but that 10 grand or so for down payment is now dispersed over the 3 years of those lease payments. And so that money is collected over that term. And then once that down payment is collected through a portion of that equity share lease payment, right? So he wouldn't actually be owner of that property until that money's collected, which is about a 3-year time period.
Yeah, I see there's a 3-year, 36-month prepayment penalty or whatever, right?
Yeah, and that's basically for their ROI, right? To make sure, because they're looking at it, hey, we're the holding company. We're going to collect the lease payments. A portion of that goes towards the down payment for the borrower. The rest is going to the holding company for their risk, essentially. And then that's where that 3-year prepayment penalty comes into play.
And I saw it was a 40-year amortized loan, right? It's not a.
They do have one on the, so you have the two columns. You have the link column, which is the straight up one. As you can see, you've got the 3-year prepayment penalty. And then you have the link convertible. And this one does allow the 40 years. So this one is a little extra flexibility, but it's going to be a higher interest rate. So they're going to get their money one way or another, because here they don't have a prepayment penalty, but then it's associated with a few other breaks in the lease and so forth. And so it's just a different way of going about it. If somebody says, I don't want a prepayment penalty, because there is that stigma, then they're going to charge a higher rate and get their ROI that way.
Okay.
Right. So it's just another alternative, but your best option is going to be the straight up link.
Okay.
But great question.
Okay. So let's say we purchase something with a link program.
Yep.
And then we need to hold this loan for 3 years minimum.
Yep.
Okay. And then you can refi.
Then it gets refied through a streamlined process, because it is FHA, and then it transfers that title from the holding company to the original buyer.
But could they refi out of FHA too? I assume.
Yes, absolutely. Yeah. So at that time, if FHA, obviously there was, some equity, increasing, everything is on the good to where we can get rid of mortgage insurance or at least reduce it because maybe the credit profile is amazing. Then yeah, then we can look at doing that straight refinance accordingly. Um, that's, an option too, because that's the beauty of this. I mean, bottom line is that people feel safe and protected, right? Because it is HUD insured. So they can rest easy knowing that, this holding company isn't going to take advantage of them. There isn't a scam behind it. It's, compared to some of the private party stuff out there, right? But it is still just a regular FHA loan. So we can address it and handle it accordingly, depending on what the best needs of that client are at the end of that 3 years. So if it means, them refinancing it entirely into a conventional loan, we can absolutely do that.
Okay.
I have a question,
Yes,
Brad.
please.
Yeah, my question is this program for those people who cannot afford a down payment?
That's essentially it, right? So you have how this one varies from a down payment assistance program is you take somebody that doesn't have any down payment, right? And the people then would either have, down payment assistance, which then in most cases now you're 100 to 103% over encumbered on the property, meaning that you'll be either a full 100% or 100 or even over that up to 103% loan to value, right? That means they're going to owe more than the property's worth. So if they have to get out of that property for any reason, minus commissions, everything, they're going to be upside down, bottom line. Right. So that's the downside of down payment assistance. This is just an alternative to that. So if somebody says, well, down payment assistance program is either too expensive or I don't want to be over encumbered, then this is an alternative to that. So instead of them having the second and or third liens on their property for down payment assistance and for the closing costs of that higher cost expensive loan, this is just another alternative. So now they basically are going to make those lease payments. A portion of it is going towards their down payment so that once they've collected that minimum down payment of 3.5% down, now it's able to transfer property or title from the holding company to them. The disadvantage to it is that then they don't get the benefits of the home ownership, meaning the interest deductions, the property taxes and so forth, because they don't legally own the property on title.
So wonder if they, during the lease, they can't do it because the lease is definitely more than what their normal payment would be, correct? So if they don't make those payments, what happens? Because they're pretty much a renter for the 3 years.
They are a renter. Yeah. So if they don't make those lease payments, because of the holding company, I mean, there are, landlord tenant agreements in place, right? So they would have to be evicted, and then the holding company would take possession of the property and sell it or do whatever they want to do with it, right?
Okay.
Because it is theirs to do. So obviously there's that inherent risk compared to having home ownership, and then being a home owner. The mortgage company would work with somebody if they ran into a hiccup in their income or being able to make those monthly payments moving forward, right? Again, you're asking perfect questions because these are questions that buyers should ask. And that's why I said it's not for everybody. It's just another tool on the belt to help somebody gain that dream of home ownership. And it's a great alternative because if they're going to continue renting anyways, and they have no means of doing down payment assistance or don't really like that, then why not? Right? Because at least that rent payment's going to be locked in. It's based on their purchase price. And they're not going to be experiencing year over year increases for the next 3 to 5 years because this is just going to be locked in, tied to what that mortgage payment is going to look like when they do take title possession later.
But it's still iffy because if in 3 years, yes, they're locked in, say the lease is 2,000, then interest rates go up in 3 years. They have to refi.
The loan's actually locked in place. So at the time, yeah, it's locked in place. The only thing that's happening is that the loan is done. The holding company is essentially making that payment on behalf of the borrower with their lease payment because that's why it's a 3-year piece. I mean, there's a portion of that is, going into the funding And so then that's why the holding company needs that 3 years to make any ROI.
Sure.
So the holding company will be paying the property tax and stuff on the property?
Correct. Yep.
Okay. So the
It's all part of the
percentage-
payment, and that's why it is based on the purchase of the home. Right, and that's obviously why there's a little bit of conservativeness. I mean, FHA, I can take, somebody looking to buy regular straight up FHA, to Krista's point, and we could run that ratio all the way up to about 45%. But on this case, in this program, they're going to usually cap it around 38, 40%. And that's to take a little bit conservative approach and also outline this so that everything is handled as part of that, right? So they would have renter's insurance, being a tenant, so that's going to be cheaper for them. The holding company is going to insure the property during the time that they hold it, but they're going to maintain it, pay the property taxes, and keep that loan in place. And then that way, when it's time to transfer title, it's just a transfer of title and transfer of ownership on the mortgage that was already in place.
Okay, so once the title is transferred after 3 years, then they will be like they have the possession right when they are living in it for 3 years, and then they will have the title.
Once they collect title, now they're
title too,
homeowners. Yep.
and then they will pay the property taxes, and then they can
Then
finance the house.
everything is now integrated. The loan takes over into a regular mortgage. There are property taxes, their insurance, because now that insurance policy is going to change and convert from a renter's policy to a homeowner's policy, because now they are designated homeowner. And so then all that's going to be impounded into the FHA loan, just like any FHA loan would have been
I
at the
think
time
this
of
is
purchase.
perfect for the people like who are renting right now, right?
It is. It's a great alternative for them, right? Because for the people that just can't get ahead, they don't have the discipline to save. When they start saving a little bit and then they dip into it, this is a great way for them to find their own discipline through the basis of just paying the rent payment.
On new builds, can you do it on a new build, FHA? I don't even know, right?
Yeah, absolutely. Once that certificate of occupancy is released, and all already is ready to roll.
Mm.
It's just not it won't go in hand with any type of a construction loan, like
Right.
what we've been talking about with a couple of the people up there in Paradise.
Okay,
But for regular EP build out, where it's just boom, it's done, and we're doing the loan at time of close. Yes, this could take factor into that.
okay, we really need to discuss this later, for
Yeah,
sure.
definitely.
Yeah. Oh, interesting.
Like I said, it's just another tool in the belt. It's a talking point, right? Because I mean, the more talking points that you as agents have with your clients, it solidifies that relationship, being able to get them to meet, and then we can have dialogue with them. But it really shows that you care about them and you have their best interest in hand if you have multiple options. And this is just another option to have their best interest. Any other questions?
I
All right, well, we
actually
got,
do.
Yeah, please,
Sorry,
Masa.
bro.
No, you're good.
So is it for people, can people who are receiving SSI, can they apply for it? And would people buying mobile homes qualify for it?
So yes, on the SSI, any income that FHA allows, which they do allow, that is no problem in this situation. The mobile homes is the only tricky part. Now, FHA does allow mobile homes as far as when they're a manufactured home on a permanent foundation. I was just looking to see if there's any. Yeah, so in this case here, ineligible manufactured homes older than 5 years. So they have a 5-year limitation to it. So it would have to be basically brand new on a permanent foundation as a manufactured home, but the mobile homes themselves are not, because most of the mobile homes still have the axles, still have, foundation issues. So even if they have a HUD label and HUD FHA loan regular would apply, this particular program, they only want the within 5 years manufactured housing. But great question.
Thank you.
All right. Well then, unless Chris, it looks like Chris just bounced out for a second, but unless Chris has anything else, we are right at the time of our 30 minutes. So Sarah Lynn, yeah, we can definitely talk about this later this afternoon if you want, or tomorrow, whatever works for you. Just give me a call, and we'll get some more material on it. Like I said, it's brand new, so our material is a little limited, but at least this gives you an idea of what we're working to and what we have at our disposal for you.
Perfect. We'll
And,
probably talk to you tomorrow. We do need some on the hometown heroes now, since it's calmed down here.
Okay.
We definitely need that.
Yeah. Then just give me a call tomorrow, and we'll get everything dialed in for you.
Okay.
Sounds good, guys.
Thank-
It was my pleasure. Yes, go ahead. Nope, sorry. I thought I heard somebody. All right, guys. Well, then we will see you all next week. And please feel free to reach out and call me if you have any other questions or other thoughts on this program or any others for that matter.
Thank you.
Thank you.
All right. Bye, guys.
Thank you.